Coming up on Business Incorporated. Angola becomes second African nation to sell Eurobonds since Russia-Ukraine war. United Nations warns East African economies exposed to Russia-Ukraine war spill. Our debt in focus as Kenya faces $7.5 billion gap in new budget. Hello, welcome to the program. I'm Ladi Williams. First off, let's take a look at how the markets are looking at intraday. Begin with the African markets where trading sentiments were positive. Nigeria's main index was in the green at intraday, up marginally again. It's like yesterday, up 0.05%, while South Africa's index had a bigger move, the green up almost 1%. Egypt's equities market closed on Thursday. Its index was down by 2.17%, while the Nairobi Stock Exchange ended Thursday's trading session in negative territory. And now to the Middle East, where major equity markets closed positive on Thursday. The Abu Dhabi and Dubai's indexes both traded in positive territory. Abu Dhabi was up by 0.87%, while Dubai had a big close, up 0.77%. Still within the region, Saudi Arabia closed in the green, up 0.44%, while the Qatari index had an even bigger close, up over 1%. All right, now let's head to Europe now. In Berlin, EU leaders have agreed on a fresh sanctions against Moscow. Finding a compromise was harder than it appeared initially. We have Chris Kober right there in Berlin. Great to have you, Chris. Well, what exactly does this package contain?
Include an import ban of Russian coal, wood, cement, seafood, and vodka. Also part of the package is a full transaction ban on 4 key Russian banks, among them VTB, which is the second largest lender in Russia. And ships flying the Russian flag are also banned from entering EU ports, although exemptions will be made for the delivery of food, humanitarian aid, and energy. There have been sticking points in the talks about the coal embargo, mainly the question of when the ban is to come into effect and which contracts it is intended to apply to. Now, the European Commission had proposed a phase-out period of 3 months, but during negotiations, that time frame was pushed back by 1 month at the request of Germany and other countries. Now, that means Russia can effectively continue sending coal to the EU until early August. And Germany will need all of this time to phase out its use of Russian coal. Chancellor Olaf Scholz said a government report this week stated that the country would likely have to switch off some of its power plants if it ended Russian coal imports straight away. Now, EU member states are pondering further measures intended to hit Russia's energy sector, like boycotting oil and gas deliveries, although they are likely to come at a much higher price to consumers and companies. Ukraine's President Volodymyr Zelensky has called on the EU to stop all Russian energy imports for what he called ruinous sanctions against Moscow.
This round of punitive measures, the Russian ruble is trading comfortably at pre-war levels. Quite interesting.
There is a number of factors at play here, one of them being the rather stringent capital controls that the government in Moscow has introduced. Companies have been ordered to convert large parts of their foreign currency reserves into rubles. Oligarchs and companies that have been hit by Western sanctions cannot transfer money from Russia to accounts outside of the country. The central bank has also limited the amount of foreign currency that can be taken or sent out of Russia, and it had doubled its key interest rate in February to 20%, trying to prevent capital flight. Analysts also point to the Russian trade balance, which could improve while gaining revenues by exporting Russian oil and gas is still possible for now. Spending money on imports of many types of goods has become much more difficult thanks to Western sanctions.
Right, and a couple of markets had late bounces yesterday. How's it looking in Europe?
There is a number of factors at play here, one of them being the rather stringent capital controls that the government in Moscow has introduced. Companies have been ordered to convert large parts of their foreign currency reserves into rubles. Oligarchs and companies that have been hit by Western sanctions cannot transfer money from Russia to accounts outside of the country. The central bank has also limited the amount of foreign currency that can be taken or sent out of Russia, and it had doubled its key interest rate in February to 20%, trying to prevent capital flight. Analysts also point to the Russian trade balance, which could improve while gaining revenues by exporting Russian oil and gas is still possible for now. Spending money on imports of many types of goods has become much more difficult thanks to Western sanctions.
All right, that's Chris Koba right there in Berlin. Thank you so much, Chris. All right, let's move on to other markets now. We see U.S. stock futures rose slightly today, but the market headed for a losing week as investors brace for tighter monetary policy from the Federal Reserve. Dow Jones Industrial Average futures climbed 78 points. S&P 500, NASDAQ 100 futures were slightly higher. Well, let's get a summary of yesterday's close from our correspondent, Maria Bird.
The U.S. stock market inched up on Thursday as it had 2 days of decline previously. The S&P 500 rose by 0.43%. The NASDAQ rose by 0.06%. And the Dow Jones rose by 0.25%. It is clear that investors are hopeful that the increase in interest rates that are going to be aggressively taken by the Federal Reserve will stabilize inflation in the U.S. They are hoping that consumer prices will show a drastic decrease over the coming months.
All right, now to our next conversation. African local currency bonds have shown more resilience than emerging market peers as domestic investors held forth significantly. The AFMI Bloomberg African Index has gained 0.7% year-to-date, outperforming the negative 5.2% pullback in the JP Morgan GBI Emerging Market Core Index. Well, we have Baboye Olaolu, economist at Cardinal Stone. Great to have you on the program.
Thank you so much.
Yeah, so the African local bond, has outperformed emerging market peers. What do you think influenced this run?
Okay, so just to put a bit of context to it, like you rightly mentioned, the African bond, the local bond has largely outperformed the emerging markets, right? The reason for this sharp decline that we saw in the emerging market bond is due to elevated capital reversals, that we're seeing from emerging markets due to tight global monetary conditions and as well as rising yields in developed markets. But for the domestic markets in the African space, the story has been a little bit different. We saw that domestic guys continue to hold the market because they hold about 65 to 70% of the entire fixed income market holdings, right? The impact of this has relatively supported the positive performance that we've seen over the last few months.
Quite interesting, but we're seeing foreign outflows from emerging markets has intensified, in recent months. But the trend is it likely to change? How long can locals actually continue to hold the fort in the domestic bond market?
So it's difficult to tell when we'll see investors return back into the market. But when we check the numbers, firstly, we saw that the global value of negative yielding bonds, which is a very key indicator to the disposition of investors in the past, we saw that the bond, the value as a percentage of the total outstanding global government bond has declined to about 4.5% as at the end of last quarter. When you compare it to 50%, in mid-2019, around August, this just gives an indication to the fact that the rising yields, has wiped out some of this negative yielding bond. Secondly, the prognosis is for yields to remain, to continue to tick upward, right? Because investors are expecting, tight monetary policy at disposition from global central bankers, right? Like we've seen from Fed has increased the rates this year by about 250 basis points. And when we check the Fed probability index, the market is already expecting or pricing in about 3 to 4 rate hikes, coupled with the one that was done some weeks back. So this just tells the story that foreign flows will likely remain risk averse of the domestic market. And in terms of how long can the domestic guys hold the market, like we rightly said, the domestic investors hold about 65% to 70% of the entire market holding. We think that they will continue to hold the market, but the duration play for them is likely short end of the curve, because of the expectations that yields will continue to rise across the market. When we check the Nigerian market, for instance, our expectation for hawkish monetary policy, elevated fiscal borrowings, all support the prognosis for short-term play. When you go to Angola, there is election risks there, and then there is also elevated borrowings from the government. We've also seen some governments like Ghana are coming up with subsidy, just to push the impact of elevated commodity prices on consumer index. All this will require fiscal spending, which might seem part of the fiscal needs, coming into the domestic market. And you might see domestic investors asking for higher yields. Hence, we think that we might be seeing more short duration play over the next few quarters.
Right, all eyes on global rate hikes. But, away from the trend, in the African region, what has been the story for Nigeria's fixed income market?
So for Nigeria, yields has trended downwards since the start of the year. We've seen very bullish sentiment. This has likely been driven by the elevated liquidity, in the market. You will recall the liquidity that we had in Q1, right, was about 43% of the entire liquidity that we're expecting in 2022 from bond maturities, bond coupon payments, FAC inflows. All this supported, the liquidity, which also fueled the bullish sentiment that we saw. Aside from this, the exemption of government bond, from tax also found an additional bullish sentiment in the market, right? And that has been the trend. But for the short end of the curve, which is the NTBs market, we've seen that investors, have remained largely risk off, from the market. And in fact, we've seen some investors rotating out of the NTBs markets into placements and corporate papers. And when we check the numbers, we saw that corporate papers and placements are currently trading at 3 to 5% premium, over the NTBs markets.
All right, so, it's a new quarter. What should we expect for Nigeria's fixed income market?
So we think that the question is, has fixed income yield to bottom yet? Right, one of the dynamics that we saw that drove the market reaction in Q1, part of it will change in Q2. For instance, the elevated liquidity that we had in Q1 will likely change in Q2, right, because of lower maturities. Secondly, the elevated fiscal deficit, right, is likely to be more pronounced from Q2. In fact, when we check the bond auction calendar, we saw that the government's intended borrowings in the markets, right, is about 50% increase than what was offered to the markets in Q1. Right, this just explained that we might be seeing more aggressive borrowing from the government, liquidity thin out, and then markets also watching the disposition of the CBN and hawkish rendition will signal to the market. So the prognosis, from Q2 is for yields to increase, and then we might see investors playing at the short end of the curve.
All right, but we'll keep watching and see how all of this plays out, because right now it's all about global rate hikes at the moment, trying to battle inflation there. Baboye Olaolu, economist at Cardinal Stone, was great having you on the program. Thank you so much.
Thank you so much for that.
All right, so we'll take a break now. When we come back, more stories on the African continent. That's in a moment. Do stay with us. Welcome back. Still watching Business Incorporated. Now to our next conversation. Kenya plans to tighten spending and step up efforts to collect more tax as it seeks to bring a ballooning state debt under control. The budget deficit is projected to drop to 6.2% of gross domestic product in the year through June 2023. Well, we have Matt Kinniger, practice leader, Sub-Saharan Africa at Front of You, joining us now. Great to have you on the program.
Hi, thanks for having me on the program today.
Yes, Matt. So what are the government's proposed spending and investment priority areas?
So quite interestingly, almost all functions that the government plans to spend on will see nominal increases, with the exception of a couple of functions that include agriculture and urban and rural development. But we are going to see quite substantial real terms increases for education, energy, infrastructure, health, and very interestingly, national security. This is not surprising because the government's Big Four agenda remains key in terms of its policy priorities. So these focus on raising productivity in agriculture, developing manufacturing, expanding affordable housing, and rolling out the National Health Insurance Scheme. So these, the Big Four continues to inform some spending priorities. But there are a couple of new measures that are quite interesting. So the government is looking to cut VAT on the manufacturing industry, especially the medical devices manufacturing industry. But very interestingly, and also a little bit of a concern, is that the government continues or plans to continue to provide budgetary support to Kenya Airways. And this is quite a controversial move because Kenya Airways has been loss-making throughout the pandemic. And arguably, there are other areas that deserve more significant funding increases. So it does show you that the Kenyan government is very keen on ensuring that the flag carrier remains a viable concern over the next year or so.
Quite interesting. But does the upcoming election play a role in the government's budget this year?
Well, it certainly will. This is because the government will aim to minimize the pain for the electorate. So even though, as you've mentioned, the government does face a very significant budget deficit, it does want to cut the budget deficit. Over the next 3 to 4 months before the election in August, the government will aim to minimize the pain that the electorate faces. This means that it will probably front load spending that it has announced, so especially on healthcare and education over the next few months. Also, it will prioritize some job creation measures, and we are expecting to see any tax increases to be delayed probably until after the election. So what we're going to see is a bit of a slowdown in spending probably after the election, and more aggressive tax increases, more aggressive tax collection measures after the election, just so that the electorate doesn't feel like it's being targeted before the election in August this year.
Right, but do you think the government's proposed, budget plans are realistic?
This is the big question, and given the sort of changes to the global macroeconomic environment we're seeing at the moment, it's increasingly uncertain. So I would say the government is likely to struggle to meet its fiscal goals, especially around cutting the deficit. So the budget deficit was estimated at about 8.7% of GDP over the last year, and it wants to cut this down to below 5% below 5% of GDP by 2025. This is not surprising. Most governments in sub-Saharan Africa are trying to do the same thing. South Africa is a very good example. But this assumes two or three things. One is that the country will enjoy continued strong economic growth, as well as strong fiscal receipts, strong and growing tax receipts over the next couple of years, but also a relatively stable currency. Now, these things are not guaranteed. We are seeing quite significant economic headwinds facing Kenya over the next year or so. In particular, Kenya is quite vulnerable to some of the fallout from the Ukraine conflict. This is because it is seeing a substantial deterioration in its terms of trade. It is seeing quite considerable downward pressure on the currency this year. The government's assumptions around the exchange rate, in our view, are not quite realistic. We are expecting the shilling to depreciate by up to 10% over the next 12 to 18 months. And this will affect debt servicing costs for Kenya, especially on its dollar-denominated debt. So what this means is that the government will face a lower than expected tax receipts, lower than expected tax receipts over the next 12 months or so because of slower economic growth, but also higher debt servicing costs because of a weaker currency. And this will constrain its ability to increase spending and cut its deficit at the same time. So certainly some substantial challenges for the government over the next year or so.
Quite a lot of for governments to chew around the world right now with this war in Ukraine and rising inflation. Thank you so much, Matt Kinniger, for coming on. Practice leader, Sub-Saharan Africa, Frontier View. Enjoy your weekend.
Thanks very much. You too.
Thank you. All right, now let's move on. We see Angola raised $1.75 billion in overseas debt, becoming the second African nation to tap the Eurobond market since the start of the war in Ukraine. 10-year debt offering, first since 2018, was priced to yield 8.7%, less than the initial guidance, and it's more than 2 times oversubscribed. The sale came after the nation, Africa's second biggest oil producer, completed a program with the International Monetary Fund last year. As the economy recovers from a recession on the back of higher crude prices. Sale follows on the heels of a similar debt issue from Nigeria, the continent's top oil producer, which was the first African country to actually tap the Eurobond market since Russia's invasion of Ukraine in late February. The nation's economy is forecast to expand 2.9% this year after exiting 5 years of recession in 2021, and the country's debt in February, with Fitch Ratings marked up its assessment actually in the previous month. And the UN has cautioned that East African economies struggling to recover from the COVID-19 hit face another crisis arising from the war in Ukraine. The United Nations Economic Commission for Africa estimates that the COVID pandemic led to the contraction of Africa's real GDP by 3% in 2020, and the Africa's debt-to-GDP ratio increased by 10 to 15 percentage points by 2021. It's from about 60% in 2019 as governments borrowed to mitigate the socioeconomic impact of the pandemic. Over the pandemic period, Kenya borrowed about 1.06 trillion shillings to mitigate its effects and budgetary support, pushing the country's public debt to 7.34 trillion shillings. Has since grown to 8.2 trillion shillings since the Central Bank of Kenya, with the data showing that this is more than an increase expected for the government. And Egypt's net international reserves dropped to $37.08 billion at the end of March from $40.99 billion the previous month as the war in Ukraine pressures the North African nation's finances. In a statement, Egypt's central bank said the conflict between Russia and Ukraine had led it to temporarily mobilize its excess foreign currency reserves to calm the markets during periods of exceptional stress. The bank cited its mandate to maintain price stability, said the move was similar to actions taken during the pandemic. A favorite destination among overseas portfolio investors in recent years, Egypt has seen some foreign outflows from its local debt market since Russia invaded Ukraine. And we've seen the appetites for riskier assets actually grow. It's also facing a steeper bill for wheat imports than are the world's largest. According to Fitch Ratings, Egypt will see reduced tourism inflows, higher food prices, and greater financing challenges. And the climate Egyptian minister held talks with World Bank officials to discuss cooperation mechanisms between two sides as Cairo prepares for a COP27 climate summit, which will be held in Sharm el-Sheikh in late 2022. The meeting tackled key initiatives and topics that will be presented at the upcoming event, as well as the latest developments in preparation for the country's climate and development report. The World Bank is preparing in several countries, including Egypt. Minister of Environment further welcomed cooperation to support Egypt's hosting of the climate summit, which seeks to implement these steps needed to accelerate climate action, present success stories from different regions for projects and programs to address the impacts of climate change. And that's the program for the week. Thank you so much for watching. I'm Ladi Williams. Enjoy your weekend.